In the alternate version of exercise 413, we're first presented with an unadjusted trial balance of Emeco Company as of December 31st, 2016. It's also noted that we use a perpetual inventory system, which is important. We're asked, based upon the information presented in the trial balance and some additional snippets of information, to prepare both adjusting entries and closing entries. Now, you may question, you've already done adjusting and closing entries in Chapter 3, so haven't we moved on? Keep in mind that was from the perspective of a service company. Now that we're a merchandiser, in particular using a perpetual inventory system, there's some additional accounts and concepts that we need to take in consideration with our adjusting and closing entries. So let's first go ahead and tackle our adjusting entries. If I look through the information listed down below, it's noted that we have some accrued expenses that we need to take care of. In fact, we have accrued sales salaries that have amounted to $2,500 that we have not yet made a journal entry for. So we have some sales staff that's done some work. It just happens that their pay period didn't match up with our December 31st reporting period, so we need to go ahead and accrue their wages. If we look through our accounts, we may note that sales salaries expense seems like it's related to this. That seems like the correct account to reflect the cost or expense of our sales staff. So we'll start to prepare our adjusting entry as of December 31st, and we'll debit the expense account called sales salaries expense for $2,500. Our credit needs to be to a liability account. Keep in mind, we haven't paid cash yet. We've got an outstanding obligation. So we're going to increase our credit sales salaries payable for $2,500. Now we look at our next sentence here, which indicates that prepaid selling expenses of $4,500 have expired. You may notice on our unadjusted trial balance, we currently have a balance of $6,500 as an asset related to prepaid selling expenses. Some of those have been used up. We need to correctly record that and expense that and lower the overall asset. The expense account related to this is going to be selling expense. So we'll debit selling expense for the expired portion of $4,500. We'll also credit the asset account prepaid selling expenses for $4,500. Some additional information listed here is that we've gone out and done a physical count of our year-end merchandise inventory and found that we only have $41,650 worth of inventory. Now you may question and say, well, I see merchandise inventory listed here of $43,000, so at any point we said perpetual inventory system, that should be the correct amount of inventory on hand. Why would you go out and do a physical count? Any company is going to have lapses in its processes, its record keeping, and internal controls. And you can expect at any point that the true amount of goods that you have on hand, while theoretically it should agree with what's in the system, may vary by somewhat. Keep in mind, again, perhaps faulty record keeping, somebody forgot to record a sale and just missed it. Also, you can suffer from inventory shrinkage, whether it be employee theft, customer theft, or just damaged goods that didn't get properly removed from the system. So at any time you can expect a slight variation from your actual count compared to what your perpetual system shows. So even if you use a perpetual system, inventory system, it's still good at least once a year, oftentimes towards the end of the year, but at least once a year to go out and do a physical count in order to make that determination of how close you are. And like this company did, if they find out that they're not on target and it really isn't 43,000, we need to do an adjusting entry to correctly reflect what the true inventory balance is. Now, we showed $41,650 on hand, but our system had a balance of $43,000, and that's a difference or a loss of $1,350. What we're going to do with that to adjust it is first debit the expense account cost of goods sold for $1,350. You may question that seems odd. That account seems only appropriate to reflect, according to its name, what's the true cost of what we sold. And I don't know that we sold this. It may have been just nature of theft or damage or per se, but keep in mind the logic is that if this balance is small, this difference is small, and that's what you expect it to be, it's just a natural part of selling inventory is sometimes your record keeping is going to fail, your internal controls are going to fail, you're going to have some shrinkage. So as long as it's small and somewhat under control, we're going to go ahead and show this as an additional cost of selling items. So we'll debit cost of goods sold. We're going to credit merchandise inventory because keep in mind our actual balance is lower than what our balance shows in merchandise inventory. So we'll credit it for $1,350. So if we look at our unadjusted trial balance and go account by account of how it's affected, our sales salaries expense we debited by $2,500. So we'll add that in the debit column under our adjustments. Selling expenses we debited by $4,500. So again, debit. Prepaid selling expenses, a credit of $4,500. So back up here, $4,500 credit. Cost of goods sold, we debit by $1,350. And merchandise inventory, we credit by $1,350. This is just simply showing our adjustments to any of these accounts. If we look at our unadjusted trial balance and factor in any of our adjustments, a $43,000 debit balance in merchandise inventory minus the credit of $1,350. Now we have our correct balance of $41,650 in merchandise inventory. A debit balance of $6,500 in prepaid selling expenses minus our expired portion of $4,500 leaves a debit balance of $2,000. Dividends doesn't change, it's still $35,000. Similar for sales of $612,000 credit balance. Sales returns and allowances, a debit balance of $20,000. Sales discounts of $3,000. Finally, cost of goods sold started with a debit balance of $215,000. We added the shrinkage of $1,350 for an adjusted cost of goods sold of $216,350. Sales salaries expense of $55,000 plus our accrued wages of $6,500 leaves us with a debit of $57,500. Utilities expenses maintain a balance of $12,000. Selling expenses start with $31,000 debit balance, add in a $4,500 debit for an adjustment, leaves an adjusted balance of $35,500, and administrative expenses remain at $104,000. So moving on, these would be our adjusted trial balance amounts that we would use in order to prepare our financial statements. Don't get too concerned. I'm not going to make you prepare the financial statements. We'll pretend as if we do. But now we're going to move on to our closing entries. If you recall, closing entries only affect what's called temporary or nominal accounts. Our permanent accounts, which assets, merchandise, inventory, and prepaid selling expenses, basically anything on the balance sheet is going to maintain and carry forward its balance, but dividends and any account on the income statement, so accounts like sales and utility expenses, anything on the income statement, only measures things for a period of time, and so we're going to have to start each new year with fresh zero balances. So we have to clear those out. Now we start out similar to what we did as a service company, where our first closing entry is going to be to close out any credit balance accounts on the income statement. Now that may sound frightening, but really the only credit balance account you're familiar with on the income statement is sales. It again currently has a credit balance. To close it out, we would debit sales for $612,000. If you recall, we temporarily transfer the balance of any sales and expenses within the closing process to a temporary account called income summary. So we'll credit income summary by $612,000. Similar to what we do with the credit balance accounts, we'll also have to look at any debit balance accounts on the income statement and also transfer them to income summary. What's new about it is typically you only saw expense accounts as debit balance accounts on the income statement. Now, and you saw typically you had the word expense in it. Now we add one additional expense, cost of goods sold, plus also we add some contra revenue accounts, which have a normal debit balance that we need to clear out. So sales returns and allowances has a debit balance of $20,000. We're going to credit it by $20,000. Sales discounts has a debit balance of $3,000. We would credit it by $3,000. Cost of goods sold has a debit balance of $216,350, so we're going to credit it. Sales, salaries, expense has a debit balance of $57,500, so we'll credit it for the same amount. Utilities expense has a debit balance of $12,000, so we'll credit it for $12,000. Selling expenses, we're going to credit it for $35,500 since it has a debit balance of $35,500. And also, last and not least, is administrative expenses. We will credit it for $104,000 since it has a debit balance of $104,000. If we add all of these up, 20,000 plus 3,000 plus 216,350 plus 57,500 plus 12,000 plus 35,500 plus 104,000. The total amount that was credited out of those debit balance accounts is going to be transferred as a debit to income summary of $448,350. So second step. Third step is, if you recall, now we're going to take that temporary balance that exists in income summary, and that amount, if you recall, should agree with the overall net income or net loss on our income statement, and we're going to transfer that to retained earnings. So let's first think about what's the balance in income summary. We credited it or increased it with our revenues or sales of $612,000. But in addition, we debited it or reduced it by our contra revenue accounts and also our expenses. So $612,000 minus $448,350 leaves a resulting balance, a credit balance, because again, our credit was bigger than our debit, a credit balance in income summary of $163,650. Income summary is a temporary account, so we need to debit that credit balance by $163,650. The total amount is then transferred to retained earnings as a credit to retained earnings of $163,650. If you recall, retained earnings is an equity account. We increase it with a credit. It seems logical since sales were greater than any contra accounts or any expense accounts that were increasing retained earnings. One last step that we have to factor in is our very last step is that we need to close out our dividends account. Dividends only reflects the amount paid out to stockholders during the current period. If you recall, dividends has a normal debit balance, so to remove it, we would credit it and it would get transferred into, or really taken out of, retained earnings. Keep in mind, retained earnings has a normal credit balance. We would increase it with a credit or decrease it with a debit. Distributing assets to stockholders in the form of dividends takes away earnings in the business. So we'll debit retained earnings by the dividend amount of $35,000. Again, dividends has a normal debit balance, so we'll credit dividends by $35,000 in order to clear out these